here we go. MSTR True North, episode 23. We are back. Let's do this. And we've got a special guest. We've got Jeff Park here today. Special guest. We've got a whole crew: Dan, Soleil, Mason, Adrian, Grain of Salt. What a day to be talking about markets. We are excited to get into it, and we are totally back. So today, we are going to go through MSTR leverage update real quick. We'll talk about strategy world, MSTR True North world. We'll give a quick update on that. We will have some new tickets that are going to be released on Friday. We've got, I think, about 40 tickets remaining and 8 sponsored tickets available. So we'll do a little brief intro of what's going on there. We're going to get into this tariff roller coaster a little bit and talk about, what we think is going on. Obviously, a huge day this week. MSTR covered call products. Jeff is launching a new covered call product with Bitwise. So we'll talk about that a little bit. Get into some financial strength relativities and, try to wrap our heads around the position MSTR is in. And then, we'll riff on whatever's left. So we got 2 Jeffs in the house tonight. So Jeff Park and myself. Jeff, thank you for joining.
Yo, happy to be here. Dream team to be a part of, and I'm so pumped that we get the chance to do this.
Yeah, glad to have you. And we're getting new guests rolling on, so this is perfect. Okay, so we're gonna talk about quick leverage update for strategy, and I'm gonna throw my screen up real quick. So leverage update as of today, 4/9/25, 528,000 Bitcoin held on balance sheet. That's 80. The Bitcoin price is 82,400. That was last time I looked at it. 43 billion of assets on balance sheet, $8.2 billion in debt, 1.6 billion of preferred stock, and 33.6 billion of net capital. So this is assets minus debt minus preferred stock. So a leverage ratio as of today of 18.9%, which is down drastically from yesterday as a result of the changing market environment. From yesterday's leverage ratio is 20.5%. So again, like to point out the Bitcoin price needed in order for MSTR's assets to be less than their debt on the balance sheet is something around $15,570. So like to point that out to tee us off here, and then we'll kick it over to Grain. Actually, before we start talking about strategy world, Tim isn't here tonight. While we may say some interesting things here tonight, none of this is financial advice. So we do not provide financial advice. This is the most interesting story in finance to all of us. That's why we get together and talk about this every week. MSTR True North, if this is your first time here, we get together every week. We talk about strategy. We talk about Bitcoin. We talk about Bitcoin Treasury companies and everything, the cutting edge of this trade. Everybody on the screen has been in the MSTR trade for a very long time and has been interested in around the evolution of Bitcoin for a very long time. So, we were planning to have these conversations internally, and our goal was to just broadcast them externally. So this is episode 23, and let's get going. Grain, over to you. A quick update on MSTR True North world.
Sure. So first of all, I want to thank everybody. We were completely overwhelmed, and we had no idea how many people would buy the tickets last week. So for a quick recap, we had 75 tickets. And we didn't even know how to price them. And so what happened was they all sold out in less than basically 12 hours, and it happened overnight. So we got a lot of DMs from people saying that they wanted to go. So the limitation that we have is the number of people that could fit at the bar, which is called the Aquamarine Bar. So with talking to strategy, we have everyone that wants to go for the remaining tickets that we're going to have for sale, which will probably go on market, Jeff, on Friday. We're thinking on Friday. So we're going to have sponsored tickets at a much higher price. And then we're going to have 40 attendee tickets for sale. And there'll be a total of 50 more tickets for sale. And that's the limit that we could have at the bar, not the conference area, but at the bar. So that's why we have to limit it. Those will go on sale on Friday, and we'll do that at noon time on Friday, and which will be 9 a.m. Pacific Standard Time. We'll announce that via tweets to the link for it. Everybody could see that. Everybody that buys the remaining tickets must also buy a strategy pass. There's no way around that. And so that way you can go to both events. So that's our new going forward plan. So we'll do that And we just hope that everybody comes there. We were really, again, amazed by the people that signed up for it. We're working on having great content, and we're really appreciative to our followers that are coming down for it.
Yeah, I think you hit the nail on the head. We will announce it to everybody. You know, the last tranche of tickets that we sold was, yeah, like Grain said, we just announced it on our show, and then it was sold out in 11 hours. So we will announce it. We'll make a time where it goes live and publish it to everybody, so everybody's got a chance to do it. But the most important part here is the remaining 40 tickets that we sell. We have to have proof of confirmation that you're attending Strategy World. So we need proof of confirmation of that ticket. So
yes. Oh, so one quick point on that. We also have a 20% off coupon for Strategy World. So you'll have, please use the MSTR True North coupon to sign up for that to get your 20% off on the strategy ticket. So we're really looking forward to seeing everyone.
Yeah, perfect.
Wow, amazing. Well, congratulations, you guys, for selling out like that. What I'm hearing, it sounds like maybe you guys need to mint an NFT club or something. And
Oh God, coming in controversial right away.
I don't know. People, there's that much demand.
Mint some NFTs for tickets. You have to have our NFT to get into the door. Oh my God.
So we, by the way, we hinted that prior to the Bitwise event, that's still something that we're working on for a party prior to that. So please stay tuned for that, and we'll see if we can get that scheduled also.
For sure.
Okay, perfect. And then somebody asked on here, can I get a refund on my ticket because I can't afford the strategy pass? If you've already bought your ticket, you do not need to buy a strategy pass. This is only for the remaining 40 tickets that we have left, and it's primarily because of capacity in the lobby and the bar. It's up against fire code, so all good there. All right, are we set, Grain?
We're all set. Let's get started.
Okay, cool. Let's get started. Obviously, a huge roller coaster in the markets over the past couple of days. We had massive crash over 3 days, followed by this absolute ripper of a day that we've had today. The whole market being up 10 to 15%, with strategy being up 22 to 25%, clocking the fifth largest single upward day in MicroStrategy stock history. So, Dan, I'm going to kick it over to you to give us a lay of the land of time of events that happened, and then we'll start riffing. Jeff, we'd love to get your perspective on what's going on here, and we'll go from there. Dan, over to you.
Awesome. Jeff Park, feel free to jump in wherever I'm missing something. I just want to go over price charts first, see kind of where we're at, and then can you see this chart fine, guys?
Yep.
Let's go over 200-day moving average price charts, 2018 tariff policy via Trump, kind of what his tweets have been saying, what has been coming from the White House over the past couple months, and just set the stage for the rest of the conversation. So here's a chart of the this is the NASDAQ QQQ with the 200-day moving average overlaid. It was a big event when we kind of dipped below the 200-day moving average in February on that tariff announcement, or in April during the Independence Day or Declaration or whatever day it was, and Liberation, excuse me. And then you can see the kind of price movements during 2018. So 2018 was a much less kind of significant price movement based on the tariffs themselves, and I'll go over that in a second. So 2018, let's just look at the chart for reference. There's a severe market correction end of 2018, but beginning of 2018 saw a little turbulence via the tariff policy, but not much. Over the past few months, we have seen obviously huge turmoil starting at the beginning of February, and I'll outline that in kind of the tweets and the timeline that Trump has put forth for this tariff policy. This is the SPY, and you've got the cues here. Starting mid-February, we're seeing this kind of recessionary breaking down of the 200-day moving average, et cetera. So if you look back on 2018, Trump announced tariffs on aluminum and steel. Again, these numbers are familiar, the 25% on steel and 10% on aluminum, effective after 18 days. Those tariffs did go into effect. The statistics regarding those, based on a few studies, concluded that for every job that was created in the U.S., it cost steel and aluminum importers about $900,000. So these were highly inflationary policies that were put into place. And then Trump continued on this tariff policy, threatening to tariff about $200 billion worth of Chinese goods on July 6th of 2018, which concluded in a 25% tariff on $16 billion worth of Chinese goods later in 2018. and a 10% tariff on 200 billion worth of Chinese goods later that year. So there was significant tariff policy enacted in 2018, and that has been continued during his first term in 2025. So now that it's 2025 and Trump announced the new tariff policies, which was always a part of his sort of campaign leading up, so we can't say we're necessarily surprised by these tariffs. February 1st was the day in which Trump imposed these 25% tariffs on Canada and Mexico. And it was April 2nd that the 10% baseline tariff was kind of suggested, and the national emergency was declared. And then obviously we all know what happened today, a 90-day pause on higher tariffs for most countries, 10% baseline, but then also increased effective tariffs for China. And so you can see that sort of market behavior in the cues here. We saw one of the largest daily candles, positive daily candles since 1967, or sorry, the largest positive daily candle in the QQQ, not daily candle, but reversal, but intraday percentage move in the Qs today since 1967. And you can see sort of the beginning of this recessionary tariff period in mid-February. So.
Amazing. Dan, in fact, could I add just one fun fact?
Yeah.
Just there's some scale of what a move today the market experienced. I believe the Q's performance today was the third best daily performance in the entire life of its existence over 25 plus years.
Was
the
it
third
really?
best
Oh
daily
gosh.
performance of the Qs. Yeah, right.
Third best.
Okay. So,
and the second best was actually right after 2008 when TARF got announced in October. And then the very best day was 2001, of course, during like the dot-com bubble. So just to put things in scale.
Wow. No, that's really important. Yeah.
All this stuff is so crazy because everything's happening so fast these days, right? Like let's go back, think about 2001, right? Who knew what their stock portfolio looked like on any one given day? Like unless you had an online brokerage account, which I'm sure, a mere fraction of the people today had any idea what their stock was, what their portfolio was doing. And now you have the ability to watch the president tweet at 1:15 in the afternoon that we're removing this, and then stocks just absolutely rip faces off, right? And it's crazy the speed at which the market is moving these days on this type of news and how the news is distributed out to the markets, right? Like nobody's waking up and looking at the Wall Street Journal going, oh, let me recalculate my portfolio today and doing it on paper. And it's just wild times.
And even my folks have been saying that, like my dad, my mom, they're just like, things move a lot quicker these days. Like, they're watching their portfolio move at the speed of light with the Trump tweets, this, that, and the next thing. And they're just like, yeah, this is not how it used to operate. And I'm a youngster, so I don't know how it used to operate. But they're saying, information just moves in a quicker speed. And that's kind of been the base of your thesis, Jeff. You've always said, like, since GameStop, since social media, like trading and the speed of information is just completely different than it was before.
Yeah, and actually the democratization of access, right? Because I remember when I was in high school, which is when I had my first stock trading portfolio. This was like in the 2000s, early 2000s. You still had to pay like $15 a pop, and like if you're managing like a pretty small like student portfolio, like man, you can't really build a diversified portfolio without those commissions eating into the idea of even allowing daily or active trading. So even that access point has totally changed for retail investors to find ways to bring trading volume into the ecosystem that wasn't possible before. Huge change.
Yeah, I remember the college days, the E-Trade. Yeah, $10 per trade. Jeff, for those that may not know you, it might be helpful to explain a little bit of your background, like just exotic derivatives trading, so people can maybe have an understanding.
Yeah, sure.
The cryptic nature of your tweets sometimes.
Yeah, happy to do this and share you some of my background. So I graduated in college in 2008. I went to Stanford. Actually, I feel like I just experienced a little bit of what a classroom felt like with Dan Hillary going down like the tariff lists of information. Did that for years and then basically started my career at Morgan Stanley. And I was an exotic derivatives trader there. And so, Jeff, as you asked, like, what does that mean? No, I don't trade endangered animals for a living. I'm not trading, sketchy drugs on the side. What exotic derivatives ultimately mean is the ability to price options basically that cannot be done through Black-Scholes. So Black-Scholes is a closed-ended formula, and it's generally suitable for American and European options where the variables are fairly fixed. But then there are certain exotic options where they introduce new features that require a deeper model that brings some stochastic modeling into the volatility surface outside of what Black-Scholes assumes, which is one volatility number as an input, right? Black-Scholes is actually pretty dumb in the sense that you can't input more than one vol number, but as you guys here are all experts, like volatility is a very dynamic, breathing, living thing that depends on actually like where the spot level in itself might be, right? That's hence the birth of the concept of a skew and the vol surface and all that kinds of stuff. But Black-Scholes doesn't account for that. And so basically exotic derivatives is the idea of trading these complex options that are out there. One day, I hope that actually crypto might get a chance to experience some of these things because you can create some really funky stuff. One of the things I bring to attention is, for example, Asian options. I don't know how many of you guys here have heard of Asian options.
I have not.
So there you go. You guys know American options and European options, right? They're fairly straightforward and vanilla. And
Should we clarify the difference just before we move forward?
Yeah, absolutely. So all options have a strike price and an expiration date in which you as the owner of the option get the chance to have the right to exercise that option or not. And with a European option, you only get to exercise it at expiration, right? You can't do it throughout the life of the options life cycle. American options, you can. So even though the expiry might be 3 months away, if it's already in the money and you want to take ownership of the stock, you can exercise that today. European options, you can't do that. That's pretty much the determining feature. And there's a little bit of like a pricing difference that results as of it because optionality, of course, is always valuable. And there's implications with things like dividends as to the timing of it. But Asian options are really different. Of course, they would call it Asian just to make it more complex and stereotypical. But
wait a second. They actually call the Asian options Asian options?
Yeah, I don't know what the history of it is.
Okay, go ahead.
It's called an Asian option. There's also Bermudan options.
Bermudian.
Bermudan options is also a category. And there is some stereotyping across those two that I won't go into the detail of this space. But Asian options are essentially the idea that instead of having one expiration as an observation point of like the spot price in which you get to exercise or not, you can get multiple observations. So if you have like a 1 year option, instead of being like pinned on just the final expiry, you can actually get an average of the monthly close in the life of a 1 year average, right? And so that means that it's actually an option that seasons with you over time, and like the risk gets smaller and smaller after each month because you're locking in a payoff as an average. So it's an averaging option, if you will, rather than like a single point of reference. Those kinds of things require something a little bit more complex than just Black-Scholes alone, and that's basically what I priced, a bunch of those types of things, and I've been doing it ever since. Now bringing that energy to crypto.
Yeah, so I love it. And Jeff, I'm fascinated with your perspective on the options market and how you see things, because having this like stochastic background of seeing like deterministic outcomes, it just has a different function of how you view the world. So, you know, bringing it back to the tariff situation, how did you, I mean, I don't know how much you trade now with your position in Bitwise, but like, how were you observing what we were seeing in the market, and how did that impact your perspective of like market conditions?
Yeah, for me, I have been generally super bullish leading into the election. And actually, I think I had pinned out like a price target based on the election using some merger arb math that we might get to as high as like 92K if Trump won. And all of those things, you know, ended up being really extremely exciting. The turning point for me a little bit was with the strategic Bitcoin reserve. That was kind of the moment for me, at least mentally, kind of realizing where we were in the exuberance of the market in terms of like the price action that we might be able to anticipate and deliver forward. And then, of course, tariffs was an overlay to that, in which it became the center point after the crypto agenda was accomplished by the White House, right? Because you have to imagine from like Trump's perspective, when he got elected, he has a bunch of things he needs to deliver. And some of those things are basically you have to because of the donor base in which they put him in that position. Crypto is obviously a big one. And the SPR like represented, in my opinion, the apex of that commitment. And once you clear that out of the picture, you knew the focus would then shift to other things, mainly tariffs. And so that's when you knew the spotlight would come kind of back to that as the macro. I had a view on how Trump would leverage the tariff war to basically bring China and other trade allies to the negotiating table. But there were some hiccups along the way that I think we're living with it now as well. That is part of the path dependency of readjusting your views on pricing and markets and all those things. For me personally today, I still think that we are not out of the woods. I think this is actually quite a challenging market to trade overall. The most shocking thing for me is that when markets move like this with this much volatility, it's generally not a great sign because that also means that there's not that much liquidity. And it's actually the most dangerous to be legging into trades or trying to buy the dip when there's no liquidity, because there tends to be a lot of autocorrelation with very volatile markets. And even though the VIX came in quite a bit, make no mistake, it's still above like 35. And the MOVE index is still above 130. And 140, 145 is the range. If the MOVE index touches, the Fed gets all upset. We're still not that far away from it. And so all these things make me think that there's still a lot of volatility to come. But hopefully you guys all recognize that in itself is kind of the opportunity, right? Like volatility can be incredible. And MicroStrategy in particular, one of the reasons I think we all love it so much isn't just because we believe in the long-term thesis of Bitcoin, but man, there's nothing more of a hot sauce to put in your portfolio than something like MicroStrategy.
So Jeff, can I chime in here? Jeff? Yeah. So a couple things. What metrics or indicators do you like to look at? And you mentioned a few of them. Do you use any of the traditionals? 50-day, 200-day moving averages, MACD, RSI, stochastic RSI. Which metrics do you look at? And then when you also mentioned liquidity, what metric do you track for liquidity?
Yeah, liquidity is a multidimensional number. The thing that is easiest to look at, of course, is traded volume, but the devil's in the details. And the way you have to observe liquidity is actually look at the order book. And when you get the ability to look at level 1, level 2 type data, you can see where the volume is occurring across the bid offer of the market. And those things are important because the order book data shows you kind of the momentum and the supply that is coming to the market, whether it be on the demand side or the supply side. And so those kinds of details are important. It's actually one that gets especially acute when you have things like option expiries on the horizon, where you get to see some of the more aggressive activities, and then you can probabilistically assign where those aggressive attributes are coming from and what kind of investor base. But those are kind of the most important things, like trading trend and momentum, like RSIs and Bollinger Bands and MACDs, all that stuff. They're great. They're really wonderful stuff. But the most important thing is you have to see the price as it moves relative to the volume that it traded. And I think people in crypto like really intuitively understand this almost better than like most stock traders, because the idea of crypto where like things are on chain and you can actually see fully transparently like where trades are clearing, like the whole idea of like realized market cap as a construct that Glassnode has published, those kinds of stuff, you actually can't see that in the equities market, right? You have no idea. Like when Costco goes up and down during this whole tariff war situation, like what is the actual cost basis of the people that are in that stock? You don't know. But crypto, you can. And I think those kinds of things are really important in how you monetize liquidity as a way to imagine, where are the pain points? Where are people going to actually start having the kinds of investor behavior that you can model? The other thing too, at a very high level that I share with everybody who's interested in learning how to think about volatility modeling is ranking like a vol regime over a period of time in which you can appreciate like a relative richness or cheapness for. So, Jeff, you mentioned that we launched a variety of covered call strategies here at Bitwise. We're super pumped about it. I think it is one of the defining features of crypto that we should bring to our investors. But I would also share with you that volatility harvesting itself is not the most stable endeavor. And sometimes it's a really good time to sell calls, and sometimes it's actually not a really great time to sell calls. I would almost argue right now is actually not like a great environment to sell calls from like the relative ranking of that richness of the premium. And the only way you actually get to observe that is you have to build a database for it and do some of the ranked decile ordering across the metrics you care for. And volatility does have a mean reverting feature to it. And so I think that's why it is one of the more useful signals that investors can develop an intuition for.
Are there any platforms that you particularly like for mapping out data? Like, what's your go-to platform? Unless it's a Bloomberg terminal, which is kind of out of reach for most people, which I'm sure it probably is.
Yeah, to be honest with you, I'm spoiled. I've had Bloomberg since the entirety of my career. So I'm a little spoiled, and I think most things we otherwise developed internally at Bitwise to have those proprietary screening tools that we'd like. But it's things that anyone with access to data could try to leverage and build off of. But Bloomberg, yes, is expensive, and the data licensing can be a little expensive.
I got a quick question on the options, just to go one level deeper. How do you know, when you look at the order book, how do you know if they're paired in a hedged position? So you could see calls, but you don't know if they're paired with a put. Do you just look at the aggregate amounts at the different strikes? And because the put call ratio may not give you a good sense of what's going on. It could, because it varies at each different, obviously, expirations and strike prices. So does that matter at all, or you just look at the overall order book for a given strike and expiration?
It's a great question. One thing I would share before answering that question is that the open interest that you see as publicly disclosed by the OCC also, like in itself, can sometimes like not be totally full in its picture. What I mean by this is there can be OTC trades that are not reported in that fashion. And then there's another category of options that are technically cleared by the OCC, and it is in fact listed and regulated as well, but is not standard contracts that you see on the option chain. These are called flex options. So you might have heard of this term, flex options, an innovation from SIBO, but basically it's a way to trade like a specific expiry that's not a listed option chain. So maybe you don't want the Friday, maybe you want, I don't know, a Tuesday. And so you have to then request the chance to trade a Tuesday contract, and maybe the strike you want is like a little bit, more granular than what the chain might give you. So you specify it. Those things also trade, and they're listed and they're cleared, but you're not going to see them like in your standard OI monitoring tools, because flexes are not often like aggregated in that fashion. And the reason I mention this is because actually a lot of these covered call type strategies in general use flex options. The reason they use flex options is also not dissimilar to the conversation we already had earlier about the difference between American and European options. All of the listed options that you see that you can trade on the option chain in your Robinhood account and whatnot, those are American options. But you can imagine for an investment vehicle having the risk of assignment on an American option where you may not actually want that assignment can pose some challenges. So you want to have the ability to have a European physical delivery. And to do that, you have to trade flex options. And so there are these nuances to the way that options exist in the universe that totally is not visible in the ways that are standard and reported.
I think you probably just freaked out most of the audience.
Yep, definitely.
But
I'm here.
Yeah. Well, I mean, there's so much data these days. I mean, somebody with your skill set and background, I mean, you can certainly generate and develop an edge based on data, but it is a bit harder to get an edge from that regard. Which kind of comes back to what you said. I don't know, about a year ago now. It's like long dated options are for buying, short dated options are for selling. And it's just like, if you take that kind of base perspective, again, none of this is financial advice, but you know, you have more optionality if you have a long dated option. If you have a short dated option, you could get your face ripped off in a day like today, where if you bought puts, you could be down 95, 100% today if you're on the
puts. Wait, somebody bought puts today?
and if you went long, I mean, the MSTR, the weekly calls were up over 1,000%, like out in the tail, like the $300 options were up, 1,500% today. So it's just face ripping in both directions.
Oh, it is. We used to have the saying at Morgan Stanley, and I think it was a pretty widely used moniker of people would come to work and they would shout, silly things on the trading floor from time to time, but you would hear people say things like, Gamma is the new Vega, or vice versa, Vega is the new Gamma. And what they're talking about here is literally, Jeff, what you're talking about. Like, there are times when it's very lucrative to trade short-dated options, which is all Gamma. And then there are times actually it's better to trade the long tail, which is mostly Vega. And depending on what the vol surface gives you, people would find that to be a way to think about arbitraging the vol surface as a market maker.
Vol surface. Define vol surface.
Yes. So volatility surface is one of the fundamental principles you have to understand with options trading. It basically starts with this idea that Black-Scholes is insufficient because Black-Scholes only takes one volatility input to get you the price of the theoretical, delta hedging replicating portfolio for what that option is. But it's not true volatility stable, and people quickly found out that there are a lot of investors who are willing to pay a lot more of a premium for out-of-the-money puts in general, right? Meaning people are willing to pay more than the implied volatility of the stock that experienced today because they need insurance. But why do they need insurance? It's usually because when markets crash, volatility also goes up, right? Like, again, like volatility moves a little bit based on the spot price itself. And so people then discover this concept of like a volatility skew, which is that not all volatility is created equal. You can't price the at-the-money option the same price as the 90% option and not the same price as the 110% option, because people have different risk preferences for what they think that vol spot correlation might be. And the most classic example is that when markets crash, volatility goes up. And usually when markets go up, volatility can either stay the same or maybe it even goes down because people actually expect mean reversion. So it will actually come back in. So it kind of looks like a generic like skew. That's half of the volatility surface. The other component is the term structure, which is basically the idea of building duration to your options. Meaning an option that expires in 30 days has to have a different volatility premium than an option expiring 1 year from now, because the risk you're taking for a longer dated option is obviously higher. So generally what you see is that there's a bit of like a contango to the shape of like a normal volatility surface. Sometimes it could also be in backwardation. You can experience that in moments of crisis like we just had, where short dated options are more valuable than what people think the volatility will be 2 years from now, because who knows what's going to be happening 2 years from now, but generally it's probably not going to be crazy. So those are the things that goes into constructing like a 3D volatility surface across strike and term structure.
All right. So this is a perfect segue, right? Obviously, you've got a really good handle on what is going on in the options market, and you guys just launched a new covered call product. So I know a lot of people love MSTY. There's a ton of people. I mean, there's a whole community call about MSTY. A lot of people are using it for income. So it'd be great if you gave us a rundown of your new product, how it compares. Is it comparable, directly comparable? And, what are some of the primary differences? I think it could be helpful.
Yeah, happy to share. MSTY is an incredible product. And it is actually, in my opinion, a real leader in having innovated upon the space of thinking about how to provide income by harvesting volatility in thoughtful ways. And they have a suite of these products that they manage, not just in crypto, but across a variety of very volatile stocks. including things like NVIDIA, Tesla, etc. We think that volatility in crypto is the most important feature, if not second to price, that people should have an ability to make a bet on. And so the cover call strategies that Bitwise launched is basically our version of trying to help investors get access to that feature of the volatility premium. And some of the things that we already talked about will make sense to you as to why there might be different ways some folks might choose to monetize the volatility premium a little bit differently. So, I think one of the biggest misconception that I've generally seen is that if you run a cover call strategy, by definition, you have to underperform the stock, right? And you commonly see people pulling up these charts where oh, here's the cover call ETF, here's the stock, and the cover call ETF underperformed while the stock went up, even though you got income out of it. I think
NAV decay, right? Like they call it the NAV decay.
Yeah. Well, the NAV decay is something else. We can definitely get into this, but I'm talking about this idea that if you cap the upside because you're selling calls against it and the stock rips and you miss out that portion, then you are basically underperforming the stock and the income isn't enough to offset that underperformance. And over a long period of time, that can accumulate into a pretty meaningful deficit, which becomes a sore thumb of why people say, oh, if you like the stock, just buy the stock. Why are you doing cover call? It always underperforms the stock. But the truth is, and many people who are really good at cover call strategies will tell you, it's not true it has to underperform, right? Because actually, if you sell calls for a premium that is worth the return for which you can get compensated for not getting assigned, and if you do a really good job of that, it's actually entirely possible you can outperform the underlying itself, right? Mathematically. Now, probabilistically, it's challenging to assume that will always be the case, but there is a path. And the thing that we want to help investors achieve is the possibility to realize an outcome that is more akin to that total return mindset rather than prioritizing income as the most important goal of owning your product. So, to make another related comment there, a lot of investors look at distribution rates with these cover call strategies, and they buy it almost based off of that distribution rate number, the bigger the better kind of idea. But here's the thing: if you squint your eye a little, if you're squinting your eye hard enough, you can almost understand the way to get the biggest distribution is to sell the most expensive option, right? Well, what's the most expensive option? The most expensive option is at the one. Exactly. It's the one at the money. Mm-hmm. So, but if you sell all the options that are at the money, then how will you ever participate to the upside of the stock? And at what price is that worth not participating on the upside of that stock? So the fundamental thing is if you just narrowly, myopically focus on distribution rate as the thing to solve for, you'll start doing things that isn't the most economic outcome. You're not thinking about implied vol anymore. You're not thinking about the delta of the call options you're selling anymore. You're actually not even thinking about the stock.
It's what just about vol. It's just vol.
Vol. But you guys know, hey, the NDX inclusion event back in November for MicroStrategy was a big catalyst. A lot of people had anticipation around that being a big signal. And if you don't have context, if you don't have awareness of fundamentals and the technical communities, and you blindly just sell at the money options around then, you may not get compensated appropriately. And so this is why I truly believe having some active overlay that can navigate those things is really, really, really important. And it's actually one of the ways that you can outperform in the totality of the NAV and the income versus another product. And that's really the way that we want to help our investors achieve a goal with their crypto portfolio.
Wow. Okay. So right. The timing is taken into consideration, understanding everything that's going on in the market. So is this fund, is it a total return fund, or will it be an income generating fund as well? Are the distributions via monthly, similar to MSTY, or what?
Yeah, absolutely. It's going to be monthly. We'll always have monthly distributions. However, one thing I will say as a differentiator versus the peer products that I have seen is that we are not programmatically going to be selling weekly options for the sake of generating that like monthly income. So again, this goes back to the perspective that like weekly options, if you sell a lot of it over time, can be a better premium inlay than selling the monthly one time. But at what cost, right? At what cost of losing out on the performance of the underlying stock in a stock like MicroStrategy? Like today, for example, right? If you sold a weekly option last week, that was like 7 to 10% out of the money for like trying to pick up that yield because you know you can roll it and do it again next week. You would have gotten assigned so badly today in ways that it wasn't worth that risk.
Right.
And so the things that we would do differently is just be mindful of the ways to think about the term structure and the vol premiums to just help navigate that journey a little bit more thoughtfully. Even though we will also have monthly distribution, it doesn't mean that the underlying constituents are going to be the same types of trading.
So this is your first income product. Is that correct?
That is correct.
I assume there's probably some more on the horizon, but you don't need to.
That's funny. It's funny. Actually, take a step back. We did at Bitwise have another income product 2.5 years ago. And that was a totally different category. It was actually in the crypto credit market in terms of accessing lending yield. And it was a great product. And actually, it did really well. But you can imagine after FTX, those types of counterparty risks were heightened with scrutiny in the ways that people did not want unsecured counterparties. And so that product is no longer with us. But I would mention that was one of our first Bitwise income products in its history.
Got it. Whereas YieldMax has got what, like 50, and it seems like again, the goal is really just monetizing the volatility, and the MSTY has done really well because it is the most volatile stock in the market, or it's gotten a lot of income in the door. Interesting. I mean, totally fascinating. Anybody else have any questions for Jeff before we shift gears and start going into other topics?
Yeah, Jeff, people in the comments,
Yeah, I do.
they're having like crippling depression imagining themselves trading against you right now.
Oh,
So
no.
just remember, you can just buy his product and you're on the same side now.
Yeah.
But yeah, so a real question is, you mentioned the implied vol being a mean reverting statistic and that right now might not be the absolute best time to sell covered calls. So unless it's proprietary, can you say whether you're holding some dry powder, like waiting for implied vol to spike so that you can, increase the amount of covered calls that you're selling? Or are you basically just selling covered calls 100%, in every environment?
Yeah, great question. We generally want to have exposure at all times to earn yield because that is the mandate of the product. It's investment effective, but there are ways to be a little bit more thoughtful based on what the market gives you at that time, right? So for example, the call that we shorted last week when the product came to market was, I believe, the 355 strike. And at the time, the delta on that strike was closer to like in the 20 range, and the vol was relatively low. Like in the ways that like when vols are low, you get greedier in wanting to trade closer options, right? You actually, because vol is so low, you creep into trading more at the money. But that's actually kind of the worst time to do it because stocks like MicroStrategy doesn't care about the implied vol surface. Like it will move when it moves, and there's almost not like an easy way to model that out. And so the worst thing you can do is actually trade near dated options when vol is low that has a lot of delta. And the best thing you could do relatively is actually go out further in the term structure and trade more out of the money than you can while still getting the yield target that you want. So when we traded that option, I think the distribution target would have been close to about 70%, which may not be as good as 100%. But at the same time, 70% is a very respectable number for the market that was provided. Now, today, we traded another contract. And for that today, as you guys saw, the MicroStrategy vol surface like did go up a bunch. At one point, it hit like 110, and then it did come back down to 195 at close. But the contract we sold today, and it's public, you can find it on our website, generated 105% yield. So what I'm trying to say is like the yield can move a lot with you based on the environment you're in. And the best thing you can do to protect yourself is be aware of the environment and try to hedge and ladder the strikes accordingly to the chance of your assignment being a likely outcome. And I feel really good about the ways that we are going to get an expert at navigating this because we're paying attention, right? Like just like you guys, I look at MicroStrategy every day. And not only do I look at MicroStrategy, I look at the 2x levered funds, MSTX, MSTU. I look at actually, I don't know if you guys saw this. There's an inverse 3x levered MicroStrategy ETF coming out in Europe. And I believe it is launching tomorrow, and it will be down like 80%. Which I thought it was hilarious, and you guys would appreciate it. Like I always tell people, like generally stay away from levered ETFs. Like what's worse than a 2x levered ETF? A 3x levered ETF. What's worse than a 3x levered ETF? A negative 3x levered ETF. What's worse than a negative 3x levered ETF? A negative 3x levered ETF on MicroStrategy.
The worst possible product ever.
Yeah. But you got to pay attention because these are the vehicles that create volume and trading. And you have to know what they're doing because they're the things that affect your daily moves. And MSTY is also a big component of creating the volatility surfaces exposures because they're a big player.
Yeah, big buyer, big seller. Yeah. Mm-hmm.
Yep.
Oh, Dan, you had another question?
Yeah, my question was just like, so Jeff, what if you're an MSTR bull, and let's say I'm a hypothetical MSTR bull, and I want to use your product to compound my share count. Like, how could I integrate your product into my spot portfolio to hopefully
MSTR yield,
earn an
MSTR yield,
yeah,
Bitcoin yield,
KPI.
or MSTR yield, yeah.
Yeah, I love that, Dan. It's such a good question. Actually, when we came to market, the question we asked ourselves was who's like the ideal customer in terms of like, is this a substitute good for MicroStrategy or is this like a complementary good? Like, do people want to own this with MicroStrategy or is it meant to be like a replacement? And what I told my team was actually, it's more complementary than not because at the end of the day, if you buy these funds, you're bullish. Like, make no mistake that when you buy these covered call strategies, you are bullish on the stock because you have linear exposure on the stock as well. So this is not like a treasury bond where like the distribution rate pays off of like 1,000 par. It's not like, STRK or STRF where the par notional is like a bond-like thing and people pay a rate off of it. No, you have underlying stock exposure. So it's actually complementary. And the ways I think it could be complementary is that there are some folks who really know volatility is an added yield concept that can be accessed, but some don't know how to do it. Or even when they know how to do it, they don't want to be bothered with it because it's actually a lot of work. You guys all know it, to pay attention to the market. And if you can just outsource it to somebody else to do it, then it achieves an investment objective that is aligned with being long MicroStrategy, but not necessarily the same outcome. And the other way I think you can think about it is like, if you do a cover call strategy really well, the other way to kind of rationalize it is that you can almost like get the stock for free. And so what I mean by that, back in November when MicroStrategy was going crazy, there were a stretch of days when the implied volatility was over 200%. This is like a number that you do not see almost anywhere else, like with the amount of liquidity that MicroStrategy had. And if you were able to monetize those call options at the time, you're able to kind of earn enough premium as if you bought the stock for free. You see what I'm saying? Like, it's actually, you're getting cash inlay from selling calls where you're lowering the cost basis of owning MicroStrategy itself. And that also mentally appeals to people where they realize if you do this really well, you can essentially get the stock for free.
Great question. Great question. And I mean, last question here, just your general thoughts on strategies design of Strike and Strife, right? I mean, these are new products attacking new markets. We had Jesse Myers on last week to talk about it, or might have been 2 weeks ago now. But I mean, what's your general thought on like the landscape here? And obviously, you're bullish. You created the MSTR covered call fund, but what's your thought on the landscape?
Yeah. I think for me, one of the greatest innovations Saylor has brought upon us is there's an incredible menu of risk preferences that people can choose and how they want Bitcoin exposure, and that's a really good thing. At the same time, the hard math is that the sum of the liabilities of a company's capital structure is finite, and the sum of the liabilities ultimately is the assets, and that's just like what a balance sheet is supposed to look like. So it is actually entirely true that you can imagine that some of these securities can be a little bit adversarial because they're making up the liabilities of the thing that then attaches to the Bitcoins that you guys just walked through at the very beginning of the show today. So in a way, there's a lot of moving parts as to how people can think about relative value across those. Today, at this moment, I think STRK, and I think I've been saying this for a while now, I think STRK is the most interesting asset for me personally. This is not financial advice. And the reason is STRK has the chance to win in two ways. Whereas MicroStrategy, the stock, really only wins by Bitcoin's price at some level and having volatility go up with Bitcoin. The other lever STRK has is it actually has a pretty explicit duration risk. And because of that duration risk, because it has a coupon and it's actually a perpetual preferred, even though STRK is callable, it means that if you think interest rates are going to go down, which I think people generally hope and think that will be the case that Trump ultimately seeks to solve for, that we're not going to be in a 4.3, 4.5% interest rate world for forever, then STRK has a way to win that is a different orthogonal path than just the common stock itself. So I think because of that component today, right now, at this moment in time, where global macro is at the center of everyone's focus on like what's the most important thing, and interest rate is in play. Like just as much as like Bitcoin was in play when the ETF launched a year and a half ago, interest rate right now is in play. And that's why I think STRK is tactically interesting. And if you take it one step further, STRF has even more duration because STRF is actually not even callable. That instrument is unlike anything I've ever seen in my entire history at Wall Street, in the sense that there's never been a preferred equity that has not been callable. Usually preferred equities have a callable period after like 3 years or so, because it's usually banks that are issuing it where they know when rates go down, they want to refinance it. STRF, as you guys may have picked up, does not have that. It's literally an infinite bond. And there's actually not even a way to retire it very easily from Saylor's perspective. And so that is also like a really interesting security if you wanted to make like a very acute interest rate bet. And I actually think that's going to be a TradFi instrument. Like that's not even going to be a thing for crypto investors like you and I, because we love Bitcoin and we want the Bitcoin risk. But if you want infinite perpetual, like a Centurion bond, right? The US doesn't have a Centurion bond like Argentina does, maybe because people don't think Argentina is going to last 100 years. But like if you want to buy a Centurion bond in the United States, like this is it. STRF is it.
So Jeff, I got a different idea for that comment. So hear me out for about 30 seconds. So maybe crypto traders will go from Bitcoin to Tether and Tether back to Bitcoin. Could this be a trading pair where you buy MSTR in bull sessions where you think it's going to run up, and then in bear markets or downturns, you revert back to STRF and STRK, because the trading range of it is so small. Based upon that, it's kind of like the Tether, whereas the MSTR is kind of like the Bitcoin. Is that a fair analogy? I
think that's a thoughtful way to say. I also think like just to like put the cover call format back in, like that's another bear market type instrument, because in a downward market where like the stock isn't performing, at least you're earning income off of it. And that is more of a buffer than just being long the stock itself. So I think there's more, similar attributes in that framework between like STRK and like a covered call ETF. I think that's very fair.
Fantastic. Well, hey, Jeff, you've been here for 55 minutes, so I know we.
Can I ask one more question?
One more. The wise man hit it.
Jeff has recently been tweeting about the Scrabble tiles. Can you explain that to the audience? And I would just love to hear your outlook going forward right now.
Yeah, for sure. So the Scrabble tiles I've been tweeting about is a really cheeky thing that I've been kind of using to jab at some trolls about what we should expect from the Fed in the near future, which is like the interest rate cut dynamic and the emergency rate cut dynamics are the most followed things. But I actually think the most important thing is not going to be that, because affecting a Fed cut doesn't change the long end of the curve. And people already know the Fed can't seem to be able to control the long end of the curve. The long end of the curve is actually what matters, right? The 10-year, the 30-year is how the United States finances its spending. And that's actually the part that needs to be attacked. And to do that, you need generally an intervention of the Treasury and the Fed to design some monetary programs that can manipulate that outcome. And people do this in emergencies. This is TARP, this was TALF, this was BTFP. And this is the thing that I'm alluding to when I mentioned Scrabble, because these are random words and letters that come together and nobody knows what it is, but it's like, oh, okay, let's just put some random letters and make it into magical things. And we probably need that to really put fire on Bitcoin, because that's the ultimate catalyst when we see like true money printing happening in the ways that people are talking about money printing. And so for that to happen, this is the sketch. The Fed and the Treasury work together. I know the mainstream media and the Wall Street Journal pretend that they do not work together and that Fed is independent and whatnot, but that has been violated many times already, where we know they work together, right? One of the ways we know they work together is because the Treasury issues bonds and the Fed is actually a buyer, right?
Yeah, they've got a relationship. Yeah, they're there.
That's literally like a left hand, right hand of the U.S. government, where they're kind of like not like trying to pretend they're not funding each other, but they kind of are, right? And this was the big deal back in March when the Fed announced that they were basically going to change the makeup of the roll-off to put a tightening on the QT program because it was a little bit too aggressive. These are the kinds of things where like you're going to see more partnerships. So the big catalyst is that at some point, the Treasury General Account, which is what's been funding most of the liquidity, is going to run out. There's no more bonds left, and they're going to have to tap the market. When they choose to tap the market, it's not clear there's going to be a lot of buyers. As we saw, there's a whole revolt based on our foreign creditors. And at that moment, you're likely, I think, again, a total guess on my end at some level, but informed by history, that you will see the Fed also participate and intervene in some kind of designed program. And those are the things that really put fire to inflation, like in debasement. And so when I refer to the Fed Scrabble, essentially, I'm trying to imagine what the next version of that might look like. And I think it's getting clearer by the day. For example, the Treasury came out 2 weeks ago and said they might need a facility to help hedge funds manage the basis trade, right? Basis trade that everyone's not talking about imploding and creating havoc in the financial market. So, well, what does that mean? Like, what is basis trading? What are those instruments? And why is the Treasury or the Fed getting involved and participating in that secondary market? These are like the little pickups that I think we're going to see more conversations come to the front.
So here's an example: the Troubled Asset Relief Program, TARP. So approximately $250 billion was committed to programs to stabilize banking institutions in 2008. $27 billion committed through programs to restart credit markets. As you can see, this is that ignition. This is that liquidity coming into the market, and it just looks different, right? It's this is the the money printer via these Scrabble programs that liquidity is coming in the door.
That's right.
All right. Well, we'll follow along. We look forward to what the next Scrabble term will be. And now your cryptic tweets make a little bit more sense.
Look, guys, thanks for having me. I've been such a fan of the shows you guys have been putting on, and proud to call myself an early fan from the beginning. And it's, to be just honest, it's amazing to see what you guys have grown here too along this journey. I think it's a testament to the community you guys have built, the personalities all involved in here, in motivating, inspirational things behind MicroStrategy and beyond. But look, this was so much fun, and I hope that we get a chance to do more of these things in the future. Bitwise compliance aside, we're all fans of all the things that you guys are doing.
Hey, Jeff, I want to say thank you. Whenever I listen to you or I read your tweets, I always learn something new. So I truly appreciate that. I appreciate you coming on. And folks, you know what? When you learn something new or you don't understand something, use AI, ask it in Grok, and then learn it. And the more you may never trade an option, and that's completely okay. But understanding that will just make you a better investor to understand the dynamics of the market. So Jeff Park, thank you so much for coming. Hope to have you back soon.
Sounds great.
Thanks, Jeff.
Thanks, Jeff.
Thank you, Jeff.
Enjoy the boat, Dan. Don't fall off it.
Thanks, guys. No, I won't.
So, Dan.
I'm going to hop off too, guys. Have a good night.
Oh, you're right. Yeah, later, Dan. Jump in the water. See ya. And I think Grain's out too.
See
So
ya.
it might just be us three.
Yeah, I'm going to bail out, guys. Thank you so much, folks. Have a great night.
Where's Adrian?
Adrian had internet issues, so he fell off.
Oh,
Sorry.
man.
But
I just spent the next hour like talking about the questions that I wanted to ask him. Like we just ran out of time. You know what I mean? I was just like, he's probably like the most bookmarked person that I follow on X, and I wanted to ask him about his radical portfolio theory and all that stuff, but that got an insta bookmark, and I still got to go down the rabbit hole on that. But like part of the short carry trade on the 40% part of that portfolio, like a small portion, like was gambling. And I'm like, that's just like, nobody says things like that. It's just so intriguing to me. And, but I wanted to ask him, like, my strategy 1080 calls are practically gambling at this point, like they're 1 degree of separation from like actual gambling. And so I wasn't sure the next thing I should do is like start to learn how to handicap like NFL games on Sunday, or high stakes, like no limit. Like where should I go from here?
Yeah, I mean, he's such an interesting guy to talk to because he clearly thinks different, right? I mean, when he sees the world through a probabilistic volatility lens, which is just like, that's got to be really hard. I can imagine just walking around seeing probabilities. I walk around and I see probabilities everywhere, but I don't see it in the volatility form that he does. But yeah, I mean, crazy stuff.
I love the,
yeah, go ahead.
No, quick comment is just, I love the comments there because people, I think we realize that we're retail, right? There's professionals in this game, and this is why you don't day trade, right? This is, at least for me, that's kind of my thought is, I have a long-term thesis and I'm sticking to that. And everything in between, I can leave it up to guys like Jeff to sweep up the market. So I think it's just a really good reminder is that there's levels to this game. And as retail, we kind of need to know our spot because we are not professionals. Jeff is clearly a professional.
Oh, well, it's crazy, right? Like these guys are doing it 24/7, 365. And right, like he's got a Bloomberg terminal. I just looked this up, and a Bloomberg terminal is approximately $32,000 a year to have a Bloomberg terminal. And that's the access to all of the data that he has access to. And now imagine having access to $32,000 a year worth of data and the infrastructure to build and manipulate that data and then create algorithms that trade based on the data and infrastructure that you see. So like, that's why he has this volatility lens, because he can see every single one of the expiration dates, all of the strikes across all of the expiration dates on the put and call side, and see like the volume and how it changes intraday and moves around. And like, that's in order to have a full lens on the market and make informed decisions, you need the best tools. And like, that's the best tools. It's almost a similar concept of like the Flash Boys thing, where there was that period of time where hedge fund trading firms were moving closer and closer and closer to the New York Stock Exchange because they would get information that much faster because the data didn't need to travel as far on like the fiber optic cables. So if they were able to get a trade in before another trader that was further away, then you were able to beat them by a penny on every single trade for like the entire like trading volume. And so it's this similar concept with like having data and like speed with like this. Computers are making this stuff move so much faster. It's crazy.
Yeah, and MSTY is already, still beating my brains in. I'm like, I don't know about an IMST challenge. That I don't know if I want that smoke. You know what I'm saying? Like,
it would have to be like degen, a little bit degen to catch the upside on some of the gambling. You've got a higher proportion of gambling in your portfolio relative to MSTY, I guess.
Yeah, and when he was talking about selling those near at the money calls like last Friday, I felt personally attacked there. I'm like, okay, he definitely saw a couple of my trades.
He's in on your computer. Yeah,
he's trying to save me from myself.
Something that really resonated with me when Jeff spoke was the fact that he said that he's paying attention and that he's in the market with us. And I think he has a great understanding of Bitcoin and MicroStrategy more generally. And I think having that edge, being able to be there every day, see the volatility, see the movements, it almost becomes a part of you. You get this sixth sense of
the pulse, right?
Yeah, it's the pulse of the market, and having a professional manage a cover call strategy for you is something that's very appealing for people because they might want to harvest volatility, as he said. So I think it's a great option out there, and I think Jeff is extremely smart, as we just saw, and he has his fingers on the market. I think it's an exciting opportunity.
Yeah. And we're going to see so many more products, right? Like Jeff is brilliant. There are hundreds of other brilliant people out there that are designing their own products with different structures. And, hedge funds are doing this separately and not necessarily taking on other people's capital and all that stuff. But yeah, I mean, it's exciting times. All of these things are good for Bitcoin too. It's just, it will, as these products evolve over time, same with Strike and Strife and now IMST and IMST, I guess, and Misty. IMST and Misty. It will bring other people into the ecosystem because they'll see it as an opportunity and they'll start to understand like trading volatility and income off of volatility and, directionally long Bitcoin. And, it's providing more interest in the stock itself, which is more interest in Bitcoin, which is just good for everybody, good for everything. I think it might be a good time to shift into this chart that I put together, the visual representation of leverage, because I think this goes into some of the same concepts because some people are always concerned, like, how does this thing break, right? And so I will share my screen and I will start walking through this. Let me know if you guys have any questions along the way. And here we go. Okay. So did we get somebody back? We got Tim. What the hell is Tim doing? Tim, where are you?
I'm trying to get these AirPods connected. Hold on.
Okay.
This is the plane again.
This is not financial advice. I think it's 4 a.m. in Paris or something, wherever he's at, and he's joining the True North stream. So
I'm back in New York.
Okay, back in New York. Just wow.
And it's darker than Ben's basement.
Yeah.
Tim, how was the Louvre with Adam back? That's out of a fever dream.
Yeah. Talk about totally unbelievable.
Yeah. Crazy.
Hold on a second.
You cut out there for a second, but
All right. Tim, we'll come back to you. Okay. All right. Tim's on mute while he gets things figured out here. But yeah, so just walking through this here. So I wanted to give a visual representation of Strategy's balance sheet and the leverage on their balance sheet. So what this is representing is over here in the middle. This is MSTR BTC balance sheet. So as of when I put this together, Strategy had $43.8 billion of Bitcoin, fiat dollars worth of Bitcoin on their balance sheet. On their balance sheet, they've got $8.2 billion of debt, and that represents all of these orange boxes here. They've also got $1.6 billion of preferred equity that represents all these small green boxes here. And the rest of the capital held on balance sheet is just excess capital, right? This is the capital they have in excess of the convertible debt that's, I guess, technically it's unencumbered, but we can just for a visual representation, that's how much convertible debt that they have on the balance sheet. And so they've got $34 billion of excess capital. And every single box on this screen represents $100 million. Now, if you look and you compare this to the current interest expense of the preferred equity, the current interest expense of the preferred equity is about $150 million, which is 1.5 boxes here over on the left-hand side. So when you compare the interest expense payable relative to the excess capital that they have on their balance sheet, this is something that's really easy to underwrite. So like if you were to provide strategy debt, if you were to provide strategy capital, like debt capital, let's just say $2 billion. If you were to provide them $2 billion and wonder if they'd be able to pay their debt, you'd look at this excess capital figure and you would think about what is the probability that this excess capital figure is so small that they're not able to pay the interest expense should they not be able to roll the debt or, sell any of the assets to pay off the interest expense or, raise any additional capital in any different way. So the current interest expense represents 0.44% of the free excess capital. It's just a mere fraction of the excess capital left here in the middle. I'm going to pause there. Do you guys have any questions on like kind of how this is laid out?
No, it's pretty straightforward.
Mason, any thoughts?
No.
Nope. Okay.
When you said each block is $100 million, I think that gives awesome perspective.
Yeah. Each one of these blocks is $100 million. Basically, they have a ton of excess capital left. Now, I wanted to put this in a different perspective, right? Because a lot of people can't conceptualize or grasp large numbers. And so I wanted to give a perspective as if this were a house, right? So let's say this is equivalent. I wanted to make this an equivalent example to as if you were buying a house and just kind of shrink down the numbers a little bit. So let's put yourself in a mortgage underwriter's shoes and trying to decide whether or not you are going to give somebody $2 million so they could buy a $2 million house. Okay. So that's the shoes I want you guys to be in. Now, under these assumptions, this person that wants to buy this $2 million house or wants a $2 million loan on the house, they have $35.6 million in assets. Okay. $1.6 million of debt, $150,000 of existing debt interest, a debt to equity ratio of 4.5%, and an annual income of $40,000. Maybe they sell pictures of their feet on OnlyFans or something and they make $40,000. Right. So my question to you, right, as a mortgage underwriter, would you underwrite this loan, right? And what would their financial situation look like if you did give them $2 million to go buy this house? The new debt that they would have on their person's individual balance sheet would be $3.6 million. Total new debt interest of $330,000. Interest expense to gross assets of less than 1%. Interest expense to net assets of about 1%, and a leverage ratio of 10%. So now I'll post it to you guys. I mean, if you were a mortgage underwriter and you had to take on this risk, would you give this person the $2 million? Like, is this a good risk, right? If you were to give them $2 million at a 9% interest rate that has $180,000 of interest expense, like, would you take on this risk?
Yes.
Like, yeah, the assets is like automatic, yes. But then I guess the wild card is the annual income. I think that might be something that people, I see people on X posting about all the time. Like, they're what if they don't have enough income to pay for it? And my immediate thought is, if selling at the market shares was fine when they were buying Bitcoin, wouldn't it be like massively more accretive if they only had to go to the ATM just barely enough to pay this little debt off? You know what I mean? Like, you don't even have to go to ATM to sell billions to buy Bitcoin with. You can just acquire Bitcoin with your STRK and your STRF, and then sell a few common shares at the market just to pay the income on, or the interest on that debt. So, that seems like a winning situation to me. But what would you say to the people who are complaining that they don't make enough money off of their
Well, the
income?
the question is, right, if you're a mortgage underwriter, and I see there's some mortgage underwriters in the chat, which is funny. Let me see the DSCR. I don't know what that is, so you're gonna have to tell me what that is. But let's think about this, right? You have $35.6 million in assets in this scenario, right? In this scenario, if your assets go up 5%, let's just say you got a 5% dividend on your assets, you're gonna have a $1.8 million gain, right? Like, you're gonna get paid $1.8 million if you have a 5% dividend rate on those assets, or just asset appreciation. So now you look at that single year gain, right? $1.8 million relative to the new debt interest that they would have of $330,000, or even the loan value, and you think, like, this is not risky, right? Almost the income doesn't matter, because if their portfolio goes up 5%, they're going to be able to pay off the debt, right? Like, the debt is, they're going to be able to pay the debt. Now, let alone if you have an asset that's compounding at 30 CAGR, right? Or 40 or 50, right? So you start to take this into perspective of like the downside here. What's the downside? Debt service coverage ratio. Debt service coverage ratio, right? That the debt coverage ratio is like, what is that, 100?
Yeah, so even at a 10% return on the assets is returning 10x the new debt interest.
Right.
So it makes it seem insignificant at that point.
It's totally insignificant, right? And so what's happening, I've basically just taken Strategy's data and converted it into a house. Just pretend this house, instead of being a $2 million loan to buy a house, it's a $2 billion loan to buy more Bitcoin. And the underlying Bitcoin has got a 30 CAGR, right? It's not a house that has a 5 CAGR in a tricky, tricky market where you don't know what the cap rate is or anything, right? So it's I've never met a TradFi underwriter that would approve this loan. What if the assets weren't Bitcoin, right? Like, even if the assets are Bitcoin, if the Bitcoin falls 50%, you're still looking at 15 million, 17 million dollars of assets relative to $3.6 million of debt. So the relativities here, right? Like, this is a not very risky loan. Like, there are many more loans that are given out to people that are significantly riskier than this, even with a significant drawdown, right? Like, even somebody put, what if there's a 50% drawdown? There's a 50% drawdown from today. Well, actually, let's think about drawdowns and probabilities, right? So the event that we saw in the markets over the last 3 days was a very significant event, right? We saw equity markets fall significantly. Equity market was down, I don't know, 15% in 3 days, 20% in 3 days. Bitcoin was down. What's it down? 32% from its all-time high?
Yeah, around 30%.
And so what is that? Is that a 1 in 4 year event? Was that a 1 in 5 year event? Is it a 1 in 1 year event? And you try to put some probabilistic framework on it. And, what does additional downside look like? Right. I think Bitcoin held up incredibly well, despite, everything else in the market going down pretty significantly on a relative basis. So what does down even further look like? What's another 50%? Is that a 1 in 100 year event? Is that a 1 in 20 year event? I don't know. So anyway, I like to think of it in this framework, right? Of just based on the $35 million of assets, if the assets grew at a 30% rate for a single year, you would generate another $11.2 million, which is 34 times the new interest expense that you have on your own personal individual balance sheet. At that point, right? If your gain in a single year is $11.2 million, you pay off the loan, you wipe your hands clean, and you go do it again, right? Like you just go do another one.
Yeah, and publicly traded companies have basically a get out of jail free card or secret weapon. Like he can sell common shares at the ATM, and now he's got two more levers with Strike and Strife. So I don't know. They're kind of like a corporate version of the government. They can just basically print money anytime they want. So if they need some money, I don't think there's any danger in them missing a payment.
Right. And this is like, I don't know. We're in bear market territory, right? We've seen a 30% drawdown, and we're talking about strategy having $33 billion of net capital, and they've accumulated a significant amount of capital since the all-time high. I mean, if we go back up to 108,000, just all-time high, strategy is looking at $47 billion of net capital held on their balance sheet, just subtracting out the existing debt, which the existing debt is convertible. It's future equity. It's debt right now, but it's future equity. So when you look at the scale chart here, of the orange boxes that are reflective of the current debt load, this debt load is actually convertible into equity. So this should evaporate. Once it converts into equity, this is gone. These turn into blue boxes.
Mm-hmm.
Right? Once it goes into the money and all of that debt converts into equity. So yeah, crazy situation. And I think a lot of people underestimate like financial strength and how powerful that could be. And this framework that I just outlined is very similar to what a mortgage underwriter does or an insurance company, how an insurance company framework works, right? Like all insurance companies are leveraged, all banks are leveraged. You have to take into consideration probabilistic outcomes and scenarios into the future to determine whether or not like you're going to be able to pay claims into the future, right? An insurance company brings in premiums. You have to run probabilistic scenarios. Is that company going to be able to pay their premiums or to pay the claims into the future? And what's the likelihood that they're able to pay their claims in downside scenarios? Like, let's say there is a 30% drawdown in the stock and bond market. Like, what does that look like? And that's how you manage risk of a balance sheet. And that's what Bitcoin treasury companies are all going to be doing into the future. And that framework is evolving and developing. So,
all right. So, sorry, finish that.
Yeah, that's it. That's it.
So if strategy, hypothetically does become a Bitcoin bank, then they're going to be on the side of having to manage those risks. And that,
Correct.
I guess that potentially, they could still be true to their word that they're never going to sell the Bitcoin, but doesn't that mean putting it at risk?
Yeah. I mean, they're putting it at risk right now, right? Like that.
Right. So, because if you loan something and, 9 out of 10 people pay it, then great. But maybe 1 out of 10 doesn't. And you have to factor that into, making sure that you're collecting enough Bitcoin to offset 10% of the people who run out on you, I guess.
Exactly. And I think it all comes down to this excess capital figure, right? Like, right. In this scenario, this is why they wanted to keep a 20 to 30% leverage ratio, because they want to be able to absorb market volatility. So they've got $34 billion of excess capital today. If you have a 50% drawdown, okay, wipe out half of this, right? Wipe out half of these blue boxes, probably all of these, right? If you had a 50% drawdown.
Yeah.
Boom. Or let's do this. Just do it on the fly. Okay. You still have plenty of capital, right? Relative to your debt. You just wiped out 50% of it. Like that's the point of managing your leverage, is so you can absorb market volatility. Now, as the price of Bitcoin rises, this box gets bigger, right? Like this box gets way bigger. It's like, okay, all of a sudden now if I have a 50% drawdown, it looks something more like this, right? And it's okay. I've got a lot more capital and I can absorb that volatility in the market. So that's what they're doing, is they're managing this ratio. And every time that they put on debt, like they're putting capital at risk, but that capital at risk has got a time horizon to it. So they're all thinking about this framework of, probabilistic downside scenarios. And when this stuff comes due, will they be able to refinance the debt or get somebody else to re-underwrite a loan to help pay off old debt, or whatever that may be. And having that excess buffer, that capital buffer, is the power of the financial strength on the balance sheet. And go ahead.
Yeah, I just think a important aspect, a key aspect, as you said, was the active management of it. If we think about back to the conversation with Jeff, how he said he has a pulse on the market, Saylor also has a pulse on the market, right? Who has a better pulse on the market than Saylor with the level of access and conversations that he's privy to? He's able to manage this leverage in line with his forward expectations. And along with that, I think another key aspect here is the capital growth aspect, which long-term, Saylor keeps on pounding the table, 13 million a coin, 13 million a coin, right? And today there was I saw this number and I did this calculation. The Mag 7 today had a market cap increase of $1.86 trillion today, right? That's almost that's like a Bitcoin right there.
Yeah,
like
that's the entire Bitcoin market cap.
Yep.
Yeah.
Or 24 MicroStrategies. I think that math is correct. I did it before, but
that sounds about right.
It's insane. When you think about the potential growth here, not only for Bitcoin, but also MicroStrategy. Or strategy. We're not going to say MicroStrategy.
We're just OG.
And I think that's OG status right
OG.
there.
Yeah.
Yeah, that was my whole point.
Anything to add there, Nitu?
Yeah, it just reminds me of I was watching Jeff Booth. We might as well go with the 3 Jeffs today. And he was talking about like this really old tweet, and someone was asking him, when will Apple buy Bitcoin? And he said, when strategy buys them.
That's possible. Yeah, that's possible.
And if he just wants 1% of the bond market, and what was it, 1% of 300 trillion?
Yep.
Like you could probably buy a few companies with that kind of cash.
Yeah. So to me, what I think that looks like down the road, it's a great question. It's a great thought experiment. The only way Saylor would buy any company is if it were accretive from a Bitcoin yield perspective. So what does that look like? Something's got to be trading way under value, like way under book value, or just like super cheap. And it's got to make so much. It's got to be so clear that it is accretive from a Bitcoin yield perspective on the horizon that it. And we might be 10 years from that, right? Like we might be 15 years from that.
Yeah.
Like they made $12 billion last year with their capital team of like 5 people, right? So they don't have to change a thing. Just keep doing what you're doing. Just offer more products to the market and just start just go out and market them, right? Like talk to capital people, get them out into the insurance market, get them into pension funds, and just keep it rolling. And once you start having difficulty, once you're like tapped out in those markets, or you're offering enough products where the market can't handle anymore, that's when you start looking to other locations to add Bitcoin yield. And that might be eating up companies that are trading at a book value, and because they don't have Bitcoin on their balance sheet, but they've got this fiat cash flow positive business, and maybe like the stock market flips upside down 8 years from now. I mean, who knows what that looks like?
Yeah, right now it doesn't make sense to go out and do acquisitions when Bitcoin's CAGR is so high. But I don't know, in 50 years, Bitcoin's, appreciating at a much lower rate. It might make sense to, I don't know, do something else with it.
Yeah. Yeah.
Then just acquire it.
Yeah.
For the
100%.
sake of acquiring it.
100%.
And something else I was thinking about too, like you don't necessarily have to stack sats to get wealthier, because like when we're not measuring Bitcoin in dollars anymore,
Yeah.
you own, like, it's capturing the deflation rate. And with AI and technology, the deflation rate is increasing exponentially. So all you got to do is hold some Bitcoin and you're getting exponentially wealthier forever. And so,
Can I?
yeah, go ahead.
No, go. No. Keep going, because I actually prepared. Jeff Booth's, he's about to pull it out. Price of Tomorrow has a really interesting section on tariffs, and I was going to kind of break it down, because it's from this concept that prices fall to the marginal cost of production in a free and open market. Essentially, what that means is prices go down over time, because that's what technology does. In the efficient market, entrepreneurs attack margins to drive it down and add value. All of us choose to go and see, we essentially seek the most value. So his perspective of tariff is really interesting, and I don't want to pivot too much, but
Hit it.
I have a
This isn't a pivot. We talked about tariffs.
All right. So, and I really agree with this, and I think it's kind of clarifying when you think about it in these terms. So the tariffs are a reaction to a deeper problem. And that problem is the fiat money system. So the US, we run a trade deficit because of Triffin's dilemma. We have the global reserve currency, and because of that, we outsource dollars. There's demand for dollars, and we import cheap goods. What does this do? It hollows out the middle class, right? And what are the negative effects of that? It's basically the rise of populism. It's kind of what Trump is all about, kind of the response to the current system that we have. But he argues that tariffs, right, are a band-aid, not really a structural fix to the issue. It doesn't go down to the root. And the root is that the root is our system is incompatible with deflation. We have an inflationary system that needs constant inflation, constant growth in order to keep it going, to keep it sustained. Technology, on the other hand, is this constant downward pressure of deflation. And what does that look like? That looks like AI, that looks like automation, less jobs, essentially. So he says job loss is mainly because of automation. That's kind of the bigger trend beyond trade, or beyond it going overseas, if that makes sense, right? So deflation is the bigger force beyond outsourcing.
Yeah.
So tariffs target that foreign competition. They say, no, we want those jobs back, but it doesn't fix the issue. The issue is the inflationary system. So, where am I?
Fix
So
the money.
our economy expects inflation and growth, but tech creates deflation and abundance. The current system blocks that deflation and abundance instead of letting prices go lower, which would help everyone. Exactly what Saylor was saying. If you didn't work, prices should be going lower. It's intuitive. We are getting better at digging holes. We are getting better at picking apples. We are getting better at doing laundry. Add in the combination of AI and robots, this is only going to progress exponentially.
Yeah.
there's also, so in our current system, the wealth centralizes. That's what we've kind of been seeing, is that it concentrates and benefits the people at the top of the system. Jeff Booth calls it, it's an extractive system. And as Americans, we benefit from that, honestly. And that's kind of a hard reality when you realize the privilege that we have in our life is because of there's 7.5 billion people who are subjugated, essentially, in this control system in which we benefit from. And this is why Bitcoin's an ethical imperative when you really understand it. So how does Bitcoin fix this? Bitcoin has a fixed supply and it's decentralized in nature, and it allows the natural deflation from technology to manifest through lower prices over time. Yep. So with Bitcoin, we can build a system that works for everyone and doesn't centralize to the top, reducing inequality and reducing tension. And honestly, the world becomes a beautiful place when things like sweatshops are automated. Like those are horrific things that humans have created, but we have the ability through problem solving to solve those issues and make the world an abundant and beautiful place.
Yeah, I mean, there's so much there. There's so much there, and I think I kind of want to start out with this: the hollowing out of the middle class, right? I mean, like all of these jobs that were typically over time in history have been in America. Manufacturing jobs have shifted overseas because of globalization, access to cheaper labor in different markets, and that's provided opportunity for other. I mean, you talked about it well. Like there's a separation, right? You've got this white collar class that's doing really well, making tons of money working on tech, and then you've got the other side of the spectrum, which is just kind of create this like really big gap in the middle. Now,
I think, hold on, just one thing: the political rhetoric around that. I think Besant said it the best. Was last summer there was the most European vacations for Americans, European vacations, but there was also the most visits to food banks. So there's two sides of the spectrum there. And of course, that's being used in kind of it's being used to justify the tariffs, right? Which I think are in nature trying to do the right thing, but I don't think they see the larger issue at hand, which is the deflationary forces and kind of the changing world that we're entering into, which even if those jobs come back, it's a lot cheaper to automate them.
Yeah. Well, and one of the weird conceptualizations here too is what do white collar jobs look like with AI, right? Like AI is going to tackle white collar jobs faster than blue collar jobs. And I think
everybody thought it was the opposite.
Everybody thought it was the opposite. And then you're like, oh my God, like lawyers, lawyers wiped out, right? Like, or not completely wiped out, but there's, lawyers are going to get a lot faster, smarter, quicker. You're going to need less of them because of the advancements of AI. Like reading a contract, AI can do it in 10 minutes. Yeah. Or can do it in 10 seconds, something that would take like 5 hours and just so much like capital cost.
Hey, Alexa, activate lawyer mode.
Yeah, boom. You're locked in. And
or you'll just have a robot to represent you. It'll be like a physical being who has the intellect of Jeff Park, right? Like
yeah. And you've got that, and I'm thinking back in my my prior jobs, or I mean the jobs that I had right out of college. I mean, for the first 5 years of my career, I was just kind of I was just like an analyst, right? Like I did a bunch of stuff. I was on the phone. I was broking deals, but I was more like the guy that did stuff for other people. And now, like my first 5 years of my job, 90% of it can be done by AI. And like the future of like white collar jobs where everybody's got a financial analyst in their pocket, or like the best, like helper, like brain helper in their pocket, is just crazy. I mean, we have no idea what that looks like because this stuff has really just come out like just recently. I mean, over the last week, I've done, 5 hours of work that would have taken me probably 2 years to do in a prior job, which is just, it can't be understated. So I see I don't know if it's panic, but I see some.
It's fear. It's genuine fear, because people aren't opposed to efficiency. When you break it down as, all right, dig this hole with a shovel, or here's an excavator, which one are they going to pick? What they're afraid of is that abundance not being siphoned to them, and that's essentially what a job represents.
Fear, yeah.
And that's what Bitcoin allows. That's what Bitcoin is the abundance in the world can be accurately measured because it's fixed. So prices go down over time because there's more abundance. And that's what's really mind blowing right now is there's going to be so much fear and so much, especially as this thing accelerates, right? As AI is used to build AI, as it's used to build factories, to build robots, right? This all compounds and it gets faster and faster. And it's going to be really volatile. It's going to be a really volatile time as people are really confused. And Bitcoin will just be this lifeboat that people will eventually, I mean, hopefully it becomes apparent at some point that what Bitcoin is actually,
that it's not a bad thing.
It's not a bad thing, but it's actually repricing the world independently of the fiat system. In the fiat system, everything will get harder, more expensive, more centralized, and you'll have to work longer and you'll get less. And Bitcoin is the complete opposite. You'll work less, you'll have more abundance. It's just the complete opposite of the fiat system.
Yeah, and I think we'll finally start to see what a proper human life cycle is going to look like, because people your age, Mason, you're not supposed to have any sats yet. So you're supposed to go out and work, and your job is to stack sats for however many years, 20, 30, 40 years, because you're working. And then when you become retirement age, you're supposed to spend your sats, because it's a zero-sum game. There's only 21 million and however many are lost. It's a closed system, so there's not going to be any Bitcoin created. So for someone to stack a sat, someone else has to spend a sat. And so, you're going to stack sats your whole life, but every sat is going to make you wealthier forever. And then when you do reach retirement age, as long as you are spending your sats at a slower rate than deflation is making you wealthier, you're good to go.
You'll be getting wealthier.
And so then, you get old and you pass the torch to the next generation of 20-year-olds whose job it is to stack sats again. And instead of it being like a perverse extractive system, like you mentioned, we're going to finally be able to see what like the real human life cycle is supposed to look like, I think.
Yeah. And capital will be allocated correctly. There'll be less capital misallocation. Like what's really,
and destruction.
Yeah, what really not radicalized me, but what kind of is really eye-opening is my generation. We're living with the burden of, we essentially burnt $8 trillion in the desert. Those were the Iraq and Afghanistan wars in the Middle East. And what did we get for those $8 trillion of essentially $8 trillion of capital allocation? What did we get in return? Well, I don't know. We got like there's countless veterans whose lives are like unimaginably difficult, and we spend $350 billion on the VA, so we have liabilities. So we spend all of that just to get $350 billion of liabilities each year. So imagine a world where in the early 2000s, instead of using those $8 trillion to go, I don't even really know what we did. but it was pretty horrific. Instead we invested in infrastructure, education,
Things that weren't destructive. They weren't
healthcare, or just let people have the money and be entrepreneurs with it.
Yeah.
Make the world a better place, upgrading the world.
It's alignment of incentives. Like Bitcoin forces the alignment of incentives because it doesn't, you're not incentivized to go to war, right? And destroy all of this wealth that has been created or like digitally created in some way.
Yeah. You can't steal the other country's wealth if it's digitally encrypted.
Right.
You can invade, but you can't leave with the Bitcoin.
Right. Wow. Yeah. Okay. A lot there. If you want to blow your brain, The Price of Tomorrow, Jeff Booth, great book. Mason's basically got it.
Yeah. That's kind of my Bible. I read that at 18, and it kind of, because there was always like a nagging issue in my head of like about inflation. I was like, so wait, every year we get better at making stuff, we get more productive, yet prices go up.
Yeah.
That didn't sit well with me.
Well, Mason, it's funny it didn't sit well with you because you weren't like you've never worked.
Yeah,
you've never worked.
Well, I'd worked a little bit, but but I don't have a career.
Okay, so one of the moments for me was like I worked for 8 years in a row in finance, and I did more and more every year. I got more efficient every year. We made more and more money every year, and I got paid more every year. My bonus went up every year. And I didn't feel like I was going anywhere. It was this hamster wheel of just like running faster and faster and faster and faster. And yet I wasn't getting anywhere. And everything else around me was like, seemed to be moving faster than me. I'm like, holy shit. What is going on? You know? And, living in Seattle, I'm also competing against like Amazon and Microsoft, two of the Mag 7. Who've just like shot up values here in a really hyper competitive location. So I also had that, I guess, competition around me, but it was just crazy.
Yeah, those are massive centralized entities who have regulatory moats, and Amazon specifically benefited from cheap capital, right?
Yeah.
ZERP. So of course they did well. They were able to borrow cheaper than everyone else.
And they ended up accumulating 20% of the Seattle commercial real estate.
Yep.
So like they have 20% of the Seattle commercial real estate, which is just insane. I mean, now that's political power too. And you like basically Bezos could tell like Seattle to do whatever, and like they kind of have to do it. They tried to put this head tax on Amazon, I don't know, 3 or 4 years ago, and Bezos was like, fine, I'll move it to Bellevue, which is like 30 minutes away, like the other city across the water. Or we'll make another HQ somewhere else on the East Coast. I'll just move to wherever I can. So it's interesting. Very interesting. Well, I mean, that's a lot of reasons to be bullish here about the future. And one of the takeaways I had 2 days ago when everything was when the market was down, everything crashed, tariffs were, going to happen the next day. So yesterday, that was yesterday. I remember thinking to myself, all of this doesn't make any sense. Like, why is Bitcoin down? Why is strategy down? And you kind of like zoom out and think about like, what are the potential outcomes of this whole situation here? And it's like, everything really points its way toward Bitcoin, right? Like, Fed drops interest rates, all right, like that's probably good for Bitcoin. This tariff stuff like continues to be a nightmare, and there's inflation. Okay, that's good for Bitcoin. It's like every scenario that I walked through my head, I was like, I couldn't imagine not owning Bitcoin right now, like as an asset. It was just,
can I just add into that? So earlier when I asked Jeff about the Scrabble tiles, what essentially he's saying there is the Fed is going to print money in some discrete roundabout fashion, which will look politically okay. It'll be called the XRT, WXYZ, whatever, crazy acronym, and they will print money, and Bitcoin will sniff that out and it'll go up. I think right now what we're living in right now is this period of 2022, which is the start of the Fed hiking rates till present. There's been QT the whole time, which is lowered liquidity somewhat. But what really hasn't happened, like the spigot hasn't been open as much as it has in the past. And when liquidity gets tight, shit starts to break. And that's really what this next phase is about, is the money, the printer is coming, right? The printer is coming. We don't know when it will be. We don't know what it will look like. We don't know what the acronym will be, but the printer is coming. And the only way to protect yourself from that in a true fashion and the best fashion is Bitcoin.
Yeah.
And MicroStrategy is the derivative of that. So it's only logically it will benefit even more.
Isn't it a really strange feeling knowing something's going to happen, but it hasn't happened yet? And you're just sitting there kind of like waiting for it, just watching it, like scrolling.
Yeah.
And like 99% of the world has no fucking clue what's going on, right? Anybody that's on Instagram or, my wife was like, I have no fucking clue what's going on. And I'm like, I don't either, but I'm paying attention and I don't know what's going on. And, and it's a strange feeling knowing that you know what the outcome is, but you don't know what it looks like or when it's going to happen. And you're just kind of sitting here in limbo, uncertainty land.
Yeah. My wife, she'll hear rumors about the market or whatever. And this is her only question. Are we okay?
I got quite a few of those. Yeah. Are we okay? I'm like, yeah, we're okay.
Yeah, we're fine.
We're okay.
We're down 25%, but we're fine.
We're okay, but so is everything else.
Yeah. If you have Bitcoin, you're okay. Unfortunately for people who don't, it's like systemic breakdown is really rough, right? And that's what we've seen. That's what Triffin's dilemma is about, right? That's the system failing.
Oh my God.
Middle class, and it has all these second order effects, these negative reflexivities, which you can't model, like the fentanyl crisis. Could you predict that in the 90s? Any model, right? And so it's like it's in the, what is it, the Big Short, where he says just don't fucking dance.
Just don't dance,
right?
yeah.
Like Bitcoin eventually is going to be screaming, but that's at the expense of a lot of people in pain. But the ultimate message is good, because we're going to a better system, which is more fruitful and abundant for everyone, no matter where you live, no matter what you look like, religion. You will have the ability to tap in permissionless. I can't say that. Permissionlessly. Yes. Yeah.
Yeah. It's anybody who's got at retirement right now, and they just like, you're 64 years old and your retirement portfolio just nuked 25%. You're like, well, what? Do I liquidate? Do I liquidate my portfolio because I want my next 10 years to be not like anybody. Yeah, it's just a really strange time.
And it's going to manifest through political tensions, which are only going to heighten, right?
Yeah, right.
If you're afraid of Trump,
midterms are going to be like this. We're going to see whiplash in the political mid. Oh my God.
If you're afraid of Trump's chaos, I was thinking about this today. If you look at the difference between Reddit and X, right? Reddit, all of them are saying sell, sell, sell. If you're afraid of Trump's chaos and the eventual, so you sell, and then the eventual outcome is all asset prices go up, which in the system of inflation, that's kind of the inevitable outcome, money printing. Well, then you just got marginally poorer than everyone who believed in Trump. So now you're even more pissed off. So you go and
more separation and
more separation, more division. And ultimately you'll vote for more inflation. You'll vote for more inflationary policies, which look like entitlements, and because people, from your perspective, you'll be like, people need help right now, and there's massive division. People are richer than ever, and people are poorer than ever.
And it's going to be this tax the rich narrative is going to hit really hard. Unrealized capital gains tax, like that's probably going to be another narrative, or UBI. We'll probably see that float up again.
All of that,
especially as AI takes people's jobs. AI is going to take people's jobs, and then there's the stock companies that have AI are going to moon and rocket. People that don't own assets are going to get totally screwed. Yeah, it's going to be weird. I mean, I couldn't imagine not owning Bitcoin right now. And that was one of the biggest takeaways I had yesterday. It was like, I couldn't imagine not holding a scarce asset right now. I mean, houses kind of too, but like even houses, if interest rates stay high, and like, that's a difficult cost benefit analysis as well. Holding a home or like portfolio homes is crazy.
Yeah. That like having the understanding that Bitcoin's outside the system is ultimately the asymmetry here in the volatility, which is it's trading as a risk on asset, but we know it's a risk off asset. Yeah. And that's the mispricing right there. And that's the opportunity. And that's what Saylor sees. That's what anyone who understands this deeply sees, that it's connected with risk on, when fundamentally this is a risk off asset. And that's why MicroStrategy is kind of like the most amazing thing in the world, because it's double risk on, and then it's it's backed by everything insurance.
Yeah, right. It's insurance, a CDO, it's collateralized debt obligation on the credit system.
Yep.
Yeah, crazy. All right, any final thoughts? I mean, that was pretty much my final thought.
That's a good way to end it.
Yeah, that's a good way to end it. I'm good. You guys good? We'll call it here?
Yeah, I'm good.
Oh, yeah.
56. We got 12,144 viewers. Thank you, everybody, for the time. I appreciate hanging out with us, and we will be back next week.